Hey, welcome back to YT Finance, where we will continue in our part 2 discussion about the top growth stocks to buy right now. The next company we're going to talk about is another technology growth company called Palantir Technologies, and their ticker symbol is PLTR. Palantir Technologies is a big data and analytics company that serves both commercial clients and government enterprises. The main draw to this company is that Palantir can literally interpret and analyze large amounts of data, and this data can then be used to make very difficult decisions in a company or on the battlefield. The PLTR stock price currently trades at $10 per share right now, which is actually a huge increase since the last time I reported on this stock, while investors think that this company is worth anywhere between $6 and $20 over the next year. However, like all of the stocks mentioned on this list, these companies have giant future growth potential. So although you may not be impressed with the next 12 months, you are most certainly going to be impressed over the next 5 years if you plan to hold the company for that long. Palantir's PLTR stock is trading at a giant discount from its former highs, and this is why many analysts deem the stock as a fantastic buying opportunity, including 5-star analysts. Now, I actually did a video going into detail into multiple articles, including this one, but I do want to read just a couple quotes from a 5-star analyst who says that after falling approximately 73% from its early 2021 peak, we see the risk to reward as compelling for a software business with a 30% growth rate, gross margin structure in the 80% range with escalating contribution margins, and a balanced commercial and government customer mix, which is absolutely phenomenal. For their government market opportunity, they are set to be a part of a market which is worth approximately $63 billion, while on the other hand, their commercial market is set to be worth around $56 billion. So clearly, this is absolutely great news for Palantir Technologies to continuously grow their company. And I also want to mention that Palantir Technologies is also supposed to grow at a 30% CAGR or greater for their revenues from now until 2025, which again, that meets our criteria for a fantastic stable growth company. Lastly, I want to mention that this 5-star analyst has a strong buy rating on this company and a $20 price target, and he's not the only one. A multitude of other 3, 4, and 5-star analysts also have buy ratings for this company that range anywhere between $13 to $20 per share, so this is very bullish. The next company we're going to talk about is Upstart, ticker symbol UPST. Upstart's stock is currently worth around $24 per share, while stock experts think that the company is worth anywhere between $14 and $69 over the next 12 months. So let's see why they actually think that. Well, Upstart is literally a cloud-based lending platform that uses artificial intelligence technology to determine who is the least likely to default on their loans and what loans can people handle. Back in December of 2020, the company went public at around $20 per share, and then that $20 surged to around $390 last October, just to fall back down to around $26 again, and right now, like we said, it's trading at around $24. So what's the deal with this company? Well, like we mentioned, this company is made to use artificial intelligence technology to approve loans for people, which is an extremely valuable platform for financial institutions to use, because normally financial institutions use the FICO scoring system. However, normally that old outdated system disqualifies multiple potential borrowers from receiving loans that they honestly could pay back. This is why Upstart's platform looks at a multitude of other factors besides the FICO score system, which would include their educational background, their area of study, their GPA, the median income for their job title, and many other factors, which puts together a more comprehensive lending profile. So although according to the FICO score system, some borrowers may be disqualified, Upstart says no, these people can still pay on their loans, so we should give it to them, which is going to be phenomenal for various financial institutions to use because they are going to charge those borrowers interest, so it's a win-win for everyone. I also want to point out that the FICO scoring system has multiple pitfalls because they are discriminatory against younger customers who haven't had time to build that credit score. So in general, Upstart is a fantastic company to own because many financial institutions actually use them. To put this into perspective, at the start, when the company had their initial public offering, Upstart only worked with around 10 lenders. Right now, the company is working working with over 500 auto dealerships and 57 different banks and credit unions, which is absolutely insane. And because of this, their bank partner loans have increased from around 215,000 in 2019 all the way up to 1.3 million in 2021. So not only is this phenomenal year-over-year growth from 2019 to 2020 and then to 2021, and we are set to get metrics for 2022 when the year ends, their conversion rate is also extremely positive. So this is why this company is rapidly growing. To add to this point, in the first quarter of 2022, Upstart's loans actually rose another 174% year over year. However, I do want to say that their conversion rate fell to around 21%. So although it's not as competitive as 24%, still it's very solid. Now, to give context to this, I do want to say that the reason for this slight decline is due to the rising interest rate environment that we are finding ourselves in right now. And although Upstart isn't an actual bank, it definitely reaps the benefits when banks and other financial institutions do well. Now, this is something that's very interesting. I personally like SoFi Technologies better than Upstart, and the reason why is because SoFi Technologies is a bank, and they can benefit from a higher interest rate environment, just like this article says, and SoFi also has their own underwriting policies, which is why they don't need to use a third party such as Upstart. Now, on the other hand, I do like Upstart, and I do own Upstart because Upstart is using their technology to benefit other financial institutions, which we will talk about later in the video. Their revenues are absolutely on a tear of increasing because back in 2019, they brought in around $160 million, while in 2021, they brought in $848.6 million. So clearly, according to a year-over-year growth rate, they are meeting our expectations of over a 30% CAGR. This is also completely in line with their adjusted EBITDA and earnings per share. So is Upstart too cheap to ignore right now? Analysts and stock professionals as well as myself say yes. Upstart's current revenue is set to rise by another 27% this year, up to $1.08 billion, with adjusted EBITDA set to decline slightly, so it's bittersweet. However, Upstart trades at just 2 times this year's sales and 16 times this year's adjusted EBITDA. So literally from a PS ratio standpoint, this phenomenal growth company is trading for very cheap, and I do think it has phenomenal long-term prospects. To push this point even further, we can look at the customers that they are landing right now. For instance, Upstart has been named the fastest growing auto retail software in the United States for Q2 of 2022. Nearly 240 dealerships have started to use Upstart's products and services, which just adds to their overall number of dealerships that they already sell to. This would include dealerships in companies such as Subaru, Volkswagen, Toyota, Lexus, Mitsubishi, and Kia, among the top franchised dealers, which would include companies like Ford, Honda, and BMW. With Upstart's AI-powered financing for the automotive market, they are expected to experience phenomenal growth over the next 5 years. And Upstart just doesn't do auto financing, they basically help financial institutions do financing for everything, not just car loans, but also personal loans, and many others, and they're anticipating to add to their portfolio as time progresses. So overall, in my opinion, it's a solid buying opportunity. And now we have our last company, which is going to be none other than Veeva Systems, ticker symbol VEEV, which trades for $220, while stock professionals think that the company is worth anywhere between $175 and $275 over the next 12 months. So why is this such a good company? Well, this is a phenomenal defensive stock. Just like we talked about with ASML Holdings, they are literally basically recession-proof because of the demand for the products and equipment that they have. In sort of the same way, SoFi Technologies also has a buffer during a recession or a high interest rate environment because they literally act as their own bank. So as interest rates rise, SoFi can have a buffer and offset some of those expenses by also increasing the interest rates for their loans. But Veeva Systems has an edge up on both of these companies because literally this is a defensive company, which are the best companies to buy in times of stock market volatility or a recession. which I think is phenomenal for long-term investors as well as short-term investors who want to fortify their portfolios right now. Veeva literally works hand in hand with the pharmaceutical industry to provide cloud-based software that helps organize and manage the various data and day-to-day activities of the life sciences industry. Veeva software helps optimize clinical data management, various types of operations, regulatory compliance on the research and development side of this industry, and they also help support customer data analytics. Veeva is by far the leader in this particular space, so why would we want to buy a defensive company that is literally the leader in this particular industry? I also want to point out that out of the top 20 pharmaceutical companies, 18 of those use Veeva Systems, so clearly they are extremely valuable for these pharmaceutical companies. I also want to say that over the last 12 months, the company has generated around $1.9 billion worth of revenue and an amazing 40% free cash flow margin. The company also projects that they are going to bring in $2.17 billion worth of revenue in the year of 2022 or fiscal year of 2023. And the best part about this company is that their demand is supposed to be sustainable even during a market downtrend and or recession. Veeva's tools are so imperative and critical for their customers that they literally couldn't survive without them. The company literally has an amazing net retention rate for their customers and their subscription service that comes in at around 119%. So basically, they just don't lose customers. But this company is also good for the long run, because while Veeva can thrive over the short term and act as a fantastic buffer that can stabilize a portfolio during recession, the company's long-term growth aspects are absolutely phenomenal, because the company is set to bring in around $3 billion worth of revenue for the calendar year of 2025, which would represent a CAGR or compounding annual growth rate of a 38% increase. And again, that meets our qualification of over a 30% CAGR in terms of their sales and revenue from now until 2025. So to me, this company is a clear buying opportunity right now based on the current stock market environment, and because it's extremely valuable to own for the long run, because I believe this company can thrive both in the short term and the long term. But I would love to hear your thoughts about any of these companies that I mentioned, which would include SoFi Technologies, ASML, Palantir Technologies, Upstart, and Veeva Systems. So remember to go and smash that like button right now. Tell me your thoughts down below, subscribe if you are new, and I'll see you in the next YT video.